So this afternoon, we're going to be talking about exploring new revenue streams and the tax considerations for that. So we're not going to dive into what is UBIT very much. It's just going to be a high level. But what I want to focus on today is thinking about your nonprofit status and what the effect of new revenue streams have on your nonprofit status, because that's something, that's your most important asset, of course. So we need to really think about that when we're thinking about new revenue streams. So if we've learned anything from the past few years, it's that nothing is rock solid except our dogs. And I have a slide on my dogs here. And they make our day better day in and day out, period. But in the current climate that we have, in an instant, the best instincts of mice and nonprofits is that one day you could just walk in and your CEO has gone to Fiji. There's another global pandemic, right? Or someone with the stroke of a pen has just eliminated your revenue stream. So we've had a lot of nonprofits lately think about, okay, we really need to look at new revenue streams. So that's why we're talking about this today, so we can think high level, what do we need to think about? So in an uncertain economic landscape, relying heavily, of course, on just one particular revenue stream, puts your sustainability at risk. So for you nonprofits that have one major donor or something, this is something that you really need to think about. So we need to think about economic downturns, of course, policy changes, or maybe your donors have changed, their criteria for who they give grants to. So those are the things we need to think about. So the best way to insulate yourself from all of the uncertainty and volatility in the market, of course, is to add more revenue streams to your mix. So, however, a nonprofit you can't just change what you're doing. You can't just switch switches. You have to think about what you're doing. So, as I mentioned, you need to think about what effect does this new revenue stream have on my nonprofit status? And do I need to think about income tax implications? So that's big picture what we're going to talk about today. Under the operational requirements of 501c3, there are several criteria that must be met on a daily basis. Daily, weekly, you can't just get exempt status and all of a sudden you're clean. So you have to think about these things. For example, you can have private benefit. However, $1 of private inurement potentially could blow your exempt status. You can have lobbying. You can have substantial lobbying, but you cannot participate in political campaign activities. But the two operational requirements that we're going to think about today is, one, do you continue to operate your organization as you told the IRS when you were granted exemption? And two, we're going to think about if you have unrelated business income, does that taint our exemption somehow? And what do we need to do about that? For many of you in the room, as you know, I work with the audit team. And as we're nearing the completion of the audit, one of the things I work on is your ASC 74010, uncertain tax positions. And so the two things that I'm looking at, I'm looking at lobbying, I'm reading your board minutes, I'm doing all of those things. But the other thing I'm looking at is, have you changed operations? Because that's important. You have to think about that. Most nonprofits don't really, think about that. They've got their mission. But when you're changing gears and you're thinking about new revenue streams, you really need to think about that. Because when I sign off that memo for audit, I'm opining that you continue to qualify under 501c3. And of course, the other thing under 501c3 is that you can have unrelated business income. It just can't be substantial. So what the code says is you must be operated primarily for tax exempt status. So let's look at our, how did we get there? Here we go. Okay, so here's our agenda. Implications for retaining exempt status. What do we look at? Unrelated trade or business income tax, federal reporting requirements, state registration reporting requirements, and state sales tax implications, because believe it or not, you might have to think about sales tax. Oh, and my dogs. As I mentioned, dogs, they're rock solid, right? But the the economic landscape out there certainly is not. So love my dogs. Okay. Does your organization continue to meet the operational requirements under 501c3? So let's think about what that means exactly. As I mentioned, we really have to think about your mission. So you can't look on the web and say, okay, our mission says this. From a legal perspective, what you need to do is you need to pull your bylaws and your articles and see what exactly does it say. You may need to revise it or edit it. You may be able to leave it as it is, or you may have to start over and just have a new mission statement. The new revenue streams that you're thinking about, you do not need to have IRS approval, in that you don't write to IRS or you don't submit a 1023 to get an updated exemption. What you do is you report that on your 990, and we'll show you that in a few minutes. Okay, so when we're thinking about our exemption, the other thing that we need to worry about is whether or not these activities will affect our exempt status from the perspective of unrelated trade or business income. The IRS code and regulations don't say what substantially operated for tax exempt purposes means. So they really don't say you can have X dollars of unrelated business income. But what we do is we look at the court cases. And so as a practitioner, we look at the court cases to see, okay, what is the IRS saying about this in tax court, right? Because they don't have anything in the code or the regulations. So the walk away from those court cases is that if you have 10% of your gross receipts from a UBI activity as compared to your total gross receipts, you start thinking about spinning that business off, right? If you have between 15 and 20%, then you start to get really nervous about, okay, is my exemption blown because I'm not operated substantially for tax exempt purposes? And as I mentioned here, over 50%, it may be difficult to retain your exemption with that. However, there is one court case out there. The entity was allowed to retain its exemption, but it had 75% of its gross revenues as UBIT. But the other side of that is the IRS looked at the use of their assets and their equipment and those sort of things. And so it was a trader business, but it didn't use a lot of the organization's assets. So they got a pass with that. Okay, so I've mentioned this, but we do need to figure out whether or not your new revenue stream is exempt function revenue or if it's unrelated trade or business income. So here is like high level definition of unrelated business income. So it's a trade or business. So if you have an activity that produces losses, is it a trade or business? Probably not. So we need to think about whether or not that activity will produce a profit. If you're using exempt assets, it should, just saying. But sometimes organizations get into activities and there's loss. It's not a UBIT activity. Regularly carried on. What does that mean? Okay, you have fundraisers probably once a year or something. The IRS will go okay with that, right? Once in a while. But if you conduct a business and you're doing it day in and day out, or several weeks during the year, then the IRS will consider that regularly carried on. Not substantially related to tax exempt purposes. So we're going to get into some examples when we get to the end, because I think it's important to look at organization's mission, what they said on their 1023, and then a fact, and see where we get to with this. But not substantially related to tax exempt purposes. I guess a good example would be if you're in the healthcare arena and you want to get into event planning, not a good idea, because you are not exempt to do that. You're exempt to provide healthcare. Okay, so if we have UBIT, we may need to think about tax, right? And so if the gross receipts from the UBIT activity is $1,000 or more, you have a 990T filing requirement and of course a state equivalent filing requirement. You're taxed at a flat 21% corporate rate, and you can claim deductions. For example, the personnel that's involved in the activity, you can deduct part of their comp and benefits against the income. Okay. So the Form 990, Part 3, Statement of Program Service Accomplishments. There's a couple questions on the 990, and this is where we would tell the IRS if we have a new revenue stream that's pretty substantial. This is where we tell the IRS. Remember, we can't write them and say update my determination letter. But we have to tell them. So these two questions would be where we would tell them. Did the organization undertake any significant program services during the year that were not listed on the prior year Form 990? And if yes, you mark it yes, you need to describe that on Schedule O. And the other question is, say for example, you ceased one of your programs, and this would be where you would report that. Did the organization cease conducting or make significant changes on how it conducts any program services? So this doesn't have anything to do with unrelated business income, right? This has to do with your program service revenue. Okay, this particular part does deal with unrelated trade or business income. Part 5, statements regarding other IRS filings and tax compliance. And I always tell my boards when I'm talking to the boards about the 990, this particular page of the 990 is where you basically confess your tax sins, right? So what else did you guys not file that you should file? But there's a question that asks about if you had gross income of $1,000 or more during the year from an unrelated business, and if so, you're required to file a 990T. Okay, this particular part of the 990 would come into play if you have to amend your bylaws. And the IRS wants you to report any significant changes on the 990. So you have to describe those. You don't attach a copy of your amended bylaws, but you do describe it on Schedule O. And of course, changing your mission statement would be a significant change. So you have to talk about that. Okay, I want to just mention raffles because this has come up a lot lately. And organizations go, oh, we're going to have a raffle. I'm like, okay, great. But did you register with the state, right? Did you get your registration number? And they're like, oh no, we have to do that. So I wanted to mention this here just because it's come up a lot lately as organizations are thinking of fundraising activities and trying to get more money in the door. The other thing, this is a game of chance, right? So you're giving the organization $2 or something for a ticket. There is no charitable component of that. So do not issue a written charitable acknowledgement for that. Okay, I don't want to spend a whole lot of time on raffles, but there's some information here on raffles. And as I mentioned, you do have to get a permit 60 days ahead of time before this raffle happens. You need to use at least 90% of the gross receipts towards charitable purposes. And you can spend no more than 10% used for the expenses. And the other thing I should mention is you can't hire someone to run your raffle, right? You have to use your in-house employees and you cannot compensate them. Some more information on raffles. Two things here. You do have to report the results of your raffle by February the following year. But my surprise when I started looking into raffles is you cannot sell tickets on the internet. You can advertise on the internet, but you cannot sell tickets. It's illegal under California law. So you have to sell only paper tickets. Okay, this particular slide You guys know about 1099 requirements and the $600 threshold. There's a little tweak with that if you have a raffle. So you can deduct the cost of the raffle ticket when you're determining whether or not the $600 is met. So the example here is the winner got $1,000. They paid $2 for that ticket. Okay, so the winnings that we need to look at when we're thinking about the 600 is $998. Okay, the other part of the raffle winnings is you have to look at whether or not it's 300 times. You have to multiply the ticket by 300 times, and if it's less, then you don't have to report it. So that's a little out. Most people don't know about that. They know, okay, it's $600, but it's not really $600. You have to think a little bit more about it. And of course, you're going to need to get names, social security numbers, addresses, and that sort of thing. Sales and use tax. So as you all know, tax exempt organizations do not have a blanket exemption from California sales and use tax. Some purchases are exempt from sales and use tax. So we have some examples here. Sales to the US government, sales of tickets for concerts, shows, that sort of thing. Sales of tickets for game booths and raffles. Raffles are not sales tax applicable. And of course, if you have a membership drive, so for example, like the LA Opera, they might have a membership drive. And so along with that membership drive, the people that are giving them money would get certain things in return. So like a teacup, right? A teacup is de minimis, so you don't have to collect sales tax on that. And last but not least on sales tax, nonprofit organizations need a seller's permit if they make sales of goods or merchandise. Whether or not they collect tax or not, that's something else, but you do need to get the license. Okay, we have examples. Okay, example number one. This is in their bylaws. Their mission to sponsor and promote educational activities of the university and hold cultural and artistic events and learning experience for the Los Angeles community. Okay. Remember I said we have to look at your 1023. So you look at your articles, bylaws, whichever one has your mission, but you need to look at your 1023. And the reason you need to do that is whatever you told the IRS you're going to do on that 1023, that's how they granted your exemption. If you're going to do something different, you have to tell them. So you have to report it on the form 990. Okay, so on their 1023, they told the IRS they were going to have film festivals, writing workshops, book fairs, and film screenings. So they're looking at new revenue streams and they're like, hey, you know, maybe we could take over the bookstore activity that the university is conducting now. It's a related entity to us. Maybe we can do that. So we're looking at the bookstore, and they sell textbooks, of course, but they also might sell merchandise, could be logo merchandise, maybe not, and beauty supply. So we really have to think about, okay, did our mission change? What are we doing? We're still promoting educational activities, I think, with the bookstore. So I don't think we really need to tweak our mission. Our mission's pretty broad, right? So we're okay on that. The 990 disclosure, we sort of need to give some thought to that. Is that a major change in your programs? If so, you need to disclose that on the 990. Is it unrelated business income? Well, we just talked about it's mission related, so it's not unrelated trade or business income, so we don't have that issue. However, we might have a sales tax issue. In general, textbooks are taxable when you sell books to students. That's what the law says. But if you dig a little deeper into the sales tax law, you will see that there is an exclusion for universities or organizations that are related to universities to not have to collect the sales tax. And so I don't know the end answer to that because I need to do some more research, but I do know that what we need to look at, what is a related organization? Like, what does that mean in sales tax? Okay, here's example 2. Our mission: to provide high quality, affordable, and comprehensive health services to improve the quality of life for the diverse and multicultural residents of Los Angeles, primarily through our healthcare facility in downtown LA. So FQHC. The FQHC doesn't have its 1023 available, so we can't really, look at that to see what they told the IRS. So but what they want to do is their new revenue stream is they want to sell prescription eyeglasses at the FQHC facility. They also want to establish a retail eyeglass operation in Malibu. Okay, so again, they're exempt. Did we change our mission? No, we're still providing high quality healthcare to the community. Do we have a 990 disclosure? I would say that's a significant change. And so they would need to tell the IRS about that change on the 990. Is it UBI? No, it's mission income. So it's not UBI. But do we have sales tax? Okay, we're selling eyeglasses if we're selling them to our patients, it's not taxable. But when they purchase the materials for the eyeglasses, they need to pay sales tax on that particular part. Okay, let's look at mission 3. Organization number 3 is exempt to provide critical resources and a continuum of care to support the unique needs of youth experiencing homelessness in Orange County. So their 1023, when they're describing to the IRS what they're going to do, they're going to provide case management, counseling services, they're going to provide meals, they're going to have both temporary and transitional housing for the homeless youth. And so, this organization is really thinking about, okay, we're losing federal grants. I hear Measure H in California, they got a lot of money to build low income housing. So let's get into that. So, there's plenty of funding out there. Gavin Newsom's, made sure we've got lots of money to build housing for low income persons. So that's where they're headed. Are they changing their mission? Oh yes, they're changing their mission. So we need to think about amending the bylaws. Okay? Or we will be amending the bylaws. Is there a 990 disclosure? Yes, because you're completely revamping what you're doing. Is it unrelated business income? No, I mean, charitable purpose would be building, homes and things like that for the low income. Sales tax, not really applicable here. Okay, our last example. This particular entity, their mission is to empower students from under-resourced communities to overcome the obstacles they face in the pursuit of a brighter future. So on their 1023, they told the IRS, we are going to provide STEAM-powered programs. I had no idea what STEAM was, right? We know what STEM is, right? We know what STEM is, but I didn't know what STEAM was. But the A that's added stands for art. So I learned something in looking at this. So they're going to have the STEAM-powered programs. They're going to have learning labs, and they're going to provide career and college readiness. They also told the IRS that as part of their fundraising activities, they were going to have a yearly golf tournament to raise funds for the organization. Turns out these guys are so good at putting on these golf events, like fabulous golf events, and people come and they love it, and they have celebrities, and it's Tiger's there or whoever's there, and so they have charities that approached them and said, hey, you guys have this great golf tournament every year. We'd love to put something on like that. Great, right? And so they were really thinking about, okay, well, yeah, maybe we could do that. The problem is they're not exempt to do that. They're exempt to provide educational opportunities. So it's not mission related at all. So we really don't even think about 990 disclosure, because what we're going to tell them is it's unrelated trade or business income activity, right? You're going to have a 990T filing requirement. You're going to have 21% tax on that income. And you really need to think about how much income this is going to produce, right? Because we need to think about, there is a 10% sort of threshold, if you will. Again, not in the code, not in the regs, but in the case law. So it's something that we really need to look closely at to ensure that you continue to retain your tax exempt status, right? Because once UBIT gets over a certain point, the IRS is going to see it. They get the 990T. So they really have to plan, what do we do once that income gets up here? And again, they're really good at it. So they're going to make a lot of money. But at that time, when we're getting, let's say 15% or so, we would say, okay, you need to spin this off. You need to establish a C Corp and keep it segregated from your exempt activity. And so that is what we would do. Okay, so I think you guys got the key takeaways in that if you're thinking about a new revenue stream, you can't just change gears and do it. You really need to think through, is it consistent with our mission? Do we need to amend our bylaws? What do we need to say on the Form 990? Do we need to worry about unrelated trade or business income tainting our tax exempt status? So we really need to analyze, what's going on. Do we really have a trade or business? The other thing we need to do, as we've mentioned, you do need to report this to the IRS. You can't write a letter. You can't apply again for exempt status. You already have that. So you have to tell them on the 990. You do need to think about sales tax, depending on what you're doing. And of course, you guys out there that are just starting in the raffle game, you can't just hold a raffle. You have to get that permit 60 days ahead of time, and you have to file a report in February the following year. So you can't just have a raffle out there. Okay, so with that, we have gone through our slides. Could I take any questions? Doug? Okay, a silent auction. So is it, can you have that? Right, it's a fundraising activity, so you can have that. Do you need to think about sales tax? Yes, right? You need to think about sales tax because people they're paying money, right? They're getting something in return. They're bidding on something. So it would be kind of like a raffle, right? You don't register as a raffle, right? Because you're not really raffling. It's not a ticket thing. It's a silent auction. So you do need to think about the W-2G. If you only do it once a year, cool. It's not regularly carried on. So it's okay. And the other thing I should mention, it's not a bad thing to have unrelated trade or business income. It's okay. It's fine. A lot of organizations do. You just need to give thought to your most important asset, which is your tax exempt status. You had a question? Yeah. Mm-hmm. Okay. So so another word I could use for that, and you usually see it in the investment arena, it's called a blocker corp, right? So when the nonprofit organization owns 100% of this C Corp, right? The income in the C Corp does not attribute up to the tax exempt entity. If you wouldn't do this, but if it were a partnership, right? You can't have a partnership with, maybe you had 99% owned by the tax exempt organization, but a partnership is a flow through entity. So anything that happens down on that level flows up. That's why we use what I would call Blocker Corp, which would be the C Corp, because everything in that C Corp stays in that C Corp. It doesn't attribute up. So no implications for your exempt status that way. Any more questions? Okay, I think we are okay. We're at 1:57. Is Gil, are you here? Are you going to introduce Rose or Roger? Okay. Thank you, everyone.